Thank you for reaching till here in your journey for inventory. I hope that so far you've understood three broad concepts. The basics, where we spoke about opening plus purchase is equal to closing plus COGS. The second, the concept of landed price or the landed cost. And the third, and a very important concept of the valuation method, where we spoke about LIFO and FIFO. I'm going to wrap the concept of inventory with this particular pre-watch session. And sometimes we feel as an accountant fraternity and as a reader of the financial statement fraternity that this concept that we are going to talk about is perhaps the ultimate destination. To reach, we have to do the previous concepts of what we spoke about. So therefore, I'm just trying to highlight the importance and the seriousness with which you got to look at this particular aspect, because this is absolutely application oriented. There's no new concept that you're going to learn. It's just that how would you apply all of that to a business situation? So here is the situation that I want to give you people, and I want you to wear your thinking hat. The situation is, let's assume you're the CFO of a company or manufacturing company who has some raw material, WIP and finished goods line. And in production of those finished goods, you've applied all the concepts learned. So you have followed, let's assume, first in, first out. And you have valued all your cost, not on the basis of purchase price only, but you've also added all the incidental cost to make it a landed cost concept. So all of that is done. And you have some inventory cost coming ready in your go down for sale at, let us say, 18.36 rupees per unit. That's one of the examples also we did together, 18.36 rupees per unit. And that's where the year closes. And that's where you take a photograph called as balance sheet, and you found out that you have 100 units of finished goods at a cost of 18.36 measured using FIFO lying with you. And you're about to close the balance sheet. You have already transferred COGS to the income statement. That's hitting the income statement as an expense. And you're about to write the value of inventory. 18.36 into 100 is about 1836 rupees in the balance sheet under the asset side, current assets. And you get a call or you get an information that because of some reason, and it could be an internal reason, it could be an external reason, but because of some reason, the market value of your finished goods has fallen below the cost at which you're holding them. Let's take, for want of any number, 15 rupees. That means in case you wish to sell your inventory, you can only sell your inventory tomorrow in the next year at a number of 15, whereas your cost is 18.36. Now, the two options that you have is do nothing, ignore this news and close the books, because anyway, this news has a lot of futuristic applications and we'll cross the bridge when it comes. Follow that mentality and do nothing. If you decide not to do anything, then this is what's going to happen. In the current year, you close your books at an inventory value of 1836. And in the next year, once you reach, you're going to make some sale. The cost is 1836 and you've been able to realize only 1500. That means you're going to book a loss of 336 at the time of sale. Perhaps that happens the next year or the year thereby, but not in the current year for sure. That's option one, do nothing right now. The other option that you have is to do something in the inventory value in the current year itself. Remember there was a concept, there was a accounting principle that we did together. Conservatism was the name. We said that accounting fraternity is very hypocrite about the way they look at their gains vis-a-vis the way they look at their expenses. And conservatism tells me or guides me to prepone any loss which is about to happen to you in the time to come for an action that you've already taken. And the action here is the production of inventory. Have you already produced inventory? Yes. If I'm talking about the inventory production that will happen tomorrow, conservatism doesn't say to bring on all hypothetical losses in the current year. No. You are holding the inventory right now. That's a reality. You're not hypothetically thinking anything, that inventory that you have, the value of that has gone down. If you don't do anything, you can already see a loss happening in the future years, and the inventory production happened in the current year, and the value reduction of inventory also happened in the current year. So conservatism guides me that should there be a situation like that, prepone that loss. Hey, but I haven't made a sale. That's fine. That's not a realized loss that we are talking about. That still is an unrealized loss. So what will happen is, the other option that as a CFO I have is, I'm going to write down the value of my inventory to the market price today. That means my 1836 inventory value will be shifted down, realizing, or I shouldn't be using the word, booking a loss of 336 rupees on a provisional basis, because it's not yet certain. I'll tell you why I say that, because tomorrow, once you make a sale, perhaps by then the price of the inventory would have again gone up. So this loss of 336 that I am booking right now today in the current year is on a provisional basis. It's 90% certain, but not 100% certain. What I'm going to do is, I'm going to mark my inventory to market value, which is MTM, mark to market concept, where doesn't matter what your book value is, bring it in line with the market value. So my inventory value is going to be shifted down. This is going to be like a loss, and it will hit my income statement in the current year itself. So I end the year at an inventory value of 1500. I end the year with an income statement with an already transferred COGS plus this 336 of an extra loss. That's a little sad current year, but that's what conservatism is. So look what will happen in the next year. Next year, let's assume on the first day itself of the next year, I made the sale. The sale price is 15. So inventory go down 1500 and cash comes up 1500. There is no loss which gets booked in the second year. So by doing this mark to market of inventory, you have preponed the loss. This is a classic example of two principles, which is historical cost concept and the conservatism. Now, in the live class, we're going to look at this more in form of a case with some numbers, with different numbers, and a very good connected, case study. And there, I perhaps will ask questions such as, what would you do if the information that would have come to you, where you were ready to take it at 1836, if the information was that the market value of the inventory hasn't gone down, on the other hand, has gone up to 25 rupees? So would you increase the value of your inventory from 1836 to 2500 as well? Would you have done that? If yes, what was the impact? If no, then why no? Okay. Now these are the things that we are going to debate, in our live class using that example and case study. Right? I'm super excited to meet you there. Thanks very much for watching this.